SpaceX just went public in one of the biggest IPOs in history, and most people assume the company is worth over $1 trillion because it launches rockets better than anyone else on Earth. That's true. It also has almost nothing to do with why SpaceX actually makes money. The rockets aren't the business. They're the delivery truck. Today, we're breaking down what's actually funding SpaceX and why the answer explains something much bigger about how Elon Musk thinks about building companies. Here's the number that explains this entire video. In SpaceX's most recent full year, its satellite internet service, Starlink, brought in roughly $11 billion, more than 60% of the company's total revenue, and growing nearly 50% year over year. Meanwhile, the part most people think of as the actual business, launching rockets for outside customers, brought in around $4 billion, and that number barely grew at all. So the rocket company isn't really a rocket company anymore. It's an internet company that happens to own the rockets. And once you see it that way, the entire strategy behind SpaceX starts to make a lot more sense. Here's the part that surprises people. SpaceX completed well over 150 Falcon 9 launches in its most recent full year, but only a small fraction, roughly a quarter, were actually for paying outside customers. NASA missions, Pentagon contracts, commercial satellite deployments. The rest, nearly 3/4 of every launch, were SpaceX launching its own Starlink satellites into orbit. In other words, most of what looks like SpaceX's rocket business is actually SpaceX supplying itself. That's the insider detail most explainer videos skip. Reusable rockets didn't just make launches cheaper for customers. They made it economically possible for SpaceX to launch thousands of its own satellites without that cost showing up as a normal expense line the way it would for literally any other company on Earth trying to build a satellite network. Every competitor trying to build something like Starlink has to buy launches from someone else at market rate again and again. SpaceX just launches its own fleet on its own rockets at whatever its actual cost is, which is a structural advantage nobody else in the industry can copy without also owning a reusable rocket fleet. So how did a satellite internet service become the thing propping up one of the most valuable private companies in the world? Starlink launched with about 10,000 users in 2021. By early 2026, it had crossed 10 million active customers across more than 160 countries and territories. That's not steady growth. That's a business that found real product-market fit and then scaled it aggressively. Here's the part that shows real business discipline, not just growth for its own sake. Starlink's average revenue per customer actually fell over that period, dropping to somewhere around $80 a month, even as the subscriber base quadrupled. That wasn't an accident, it was a deliberate trade-off, sacrificing revenue per customer to win volume and market share first. Then, once the customer base was locked in, SpaceX started raising prices again in 2026, the classic playbook of subsidizing growth first, then monetizing the installed base once you own the market. There's also a piece most people never think about. A chunk of Starlink's growth comes from a military and government version called Starship, under contracts worth hundreds of millions of dollars with defense agencies. That's Starlink's technology, repackaged for a customer that doesn't care about consumer pricing wars. It cares about reliability, and it pays accordingly. So if Starlink is the real business, is SpaceX actually as safe a bet as its trillion-dollar valuation suggests? Not exactly. Company launch rockets. It's whether Starlink's cash flow can keep funding an increasingly ambitious set of side bets, Starship Mars and now Orbital AI, without one of them eventually outrunning what the profitable part of the business can sup. Earlier this year, SpaceX merged with Musk's AI company, xAI, in an all-stock deal that combined the two into one entity valued around $1.25 trillion. The pitch is ambitious, putting AI data centers in orbit, where there's unlimited solar power and no need for the massive cooling systems data centers require on Earth. Here's the tension. xAI is reportedly burning through billions of dollars a quarter with no clear near-term path to profitability, and now that spending sits inside the same company whose valuation is largely justified by Starlink's actual cash flow. Starlink is the profitable engine. Rockets are a moderately profitable service business, and now there's a third piece, Orbital AI computing, that's pure expensive bet, riding on the back of the first two. That's the real risk in the SpaceX story right now. It's not, can this company launch rockets? It's whether Starlink's cash flow can keep funding an increasingly ambitious set of side bets, Starship, Mars, and now orbital AI, without one of them eventually outrunning what the profitable part of the business can support. So is this genius long-term structuring, or an increasingly risky bet dressed up as one company? The bull case is straightforward. Starlink already proved it can go from a capital-burning moonshot to a genuinely profitable, fast-growing subscription business in a few short years. If it keeps that trajectory, it can fund an enormous amount of ambition elsewhere in the company. The bear case is just as real. SpaceX just went public, meaning for the first time this entire structure is exposed to public shareholders who expect quarterly discipline, not just visionary roadmaps. If Starlink's growth slows or competition from other satellite networks catches up faster than expected, the company doesn't just miss a launch. It has to explain to public markets why it's still pouring Starlink's profits into a Mars program and an unprofitable AI data center bet in space. That tension, visionary spending versus public market patience, is the one thing that didn't exist for SpaceX a year ago, and it's the thing worth watching most closely from here. So here's the real takeaway. SpaceX isn't a rocket company that happens to have an internet side project. It's an internet company that happens to own the rockets, using that internet business to fund one of the most ambitious sets of side bets any company has ever attempted at the same time. That's the same structure behind a handful of other companies that look like they do one thing, but are actually funded by something completely different working quietly in the background. If you want to see that same pattern in a totally different industry, check out our breakdown on Reference Your Relevant Economics of Owning video. The logic is nearly identical. If this breakdown was useful, subscribe. New economics breakdowns drop every week. See you in the next one.